We are going to buy an entire company.
A hypothetical company. Let's, keep the math really clean. This company is a perfect machine.
Okay.
It earns exactly $100 million a year in profit, cash in the bank, every single year.
Okay, so I have my target, a business that prints $100 million annually. I want it known it. I walk up to the owner and I say, I want to buy 100% of this.
Right.
The big question is, what do I write on the check?
And this is where most people, I think, get stuck. They look for comps or they look at market sentiment.
Yeah, all that jargon.
But our deep dive today suggests we need to look at something much more primal. We need to look at time.
Time. Okay, walk me through that. Because usually when we talk about valuation, we hear about the multiple, the price to earnings ratio.
Right.
And it just sounds like a scorecard.
It does sound like a score, but it's a countdown clock.
A countdown clock?
Yeah. The multiple is just a simple way of asking, how many years am I willing to wait to get my money back?
Okay, let's test that. Our $100 million company. If I pay $100 million to buy it.
Then you have a PE of 1, a multiple of 1. You paid 1 times the earnings.
Yeah.
So, since the company makes $100 million a year, how long until you have your investment back?
1 year. I pay $100 million, I wait 12 months, I collect the $100 million profit, I'm whole.
Exactly. Now, let's say the owner is a little difficult. Yeah. He says, no, this is a great business. I want $200 million for it. Okay, so if I agree to that, I pay $200 million, it still only makes $100 million a year. So now I'm waiting 2 years to break even.
Your multiple is 2, your wait time is 2 years. Simple as that.
This frame is actually really helpful.
Yeah.
It kind of removes the abstraction. If I pay a multiple of 10, I'm essentially saying, I accept that I will not see a net profit on this purchase until a decade from now.
Precisely. You are buying a stream of future cash flows. The higher the price you pay, the further into the future you have to look to justify it.
So you're paying for 2030, 2035, 2040, but you're paying for it today.
You are.
And this creates a massive conflict, right? The source material describes it as a tug of war between the buyer and the seller. It's a perfect description. They aren't just negotiating a price. They're negotiating time and risk.
Let's break that down.
Okay, think about the psychology. If you are the seller of this business, what's your motivation? Why are you selling a machine that just prints money?
Well, I suppose I want to de-risk, right?
Yeah.
If I keep the business, I have to run it. I have to worry about regulations or the factory burning down or, I don't know, taste changing.
All of it.
If I sell it, I get a lump sum. I can go sit on a beach.
Right. You want to front load your rewards. You want someone to pay you for the next 10 or 20 years of earnings right now.
So I don't have to wait.
So you don't have to wait for them. You want the highest multiple possible.
But as the buyer, I have the exact opposite incentive.
The complete opposite.
I'm the one taking on the headache. I'm the one who has to worry about the factory. So I want to pay as little as possible to shorten that risk window.
Exactly. The buyer thinks, I don't want to wait 20 years to get my money back. I mean, that's an eternity in business. I want my money back in 3 years.
So the stock price you see on the screen is just the settlement point. It's where those two opposing views met.
The buyer gave up a little safety, and the seller gave up a little bit of future upside.
But here's where it gets interesting. The source material throws out an extreme example to prove the point. Mm-hmm. What if the seller demands $5 billion for this company?
$5 billion for a company making $100 million.
Yeah.
Okay. Run the math. What's the multiple?
5 billion divided by 100 million. That's a multiple of 50.
And what does that mean in plain English?
It means I am writing a check today and I won't break even until, 50 years from now?
A half century.
That seems insane.
Right. You're literally saying, I am perfectly happy to wait until the year 2076 just to get my principal back.
I mean, who knows if the world will even exist in 50 years, let alone this specific company.
If you're the buyer, you're walking away.
No deal. I'm not taking that.
And if you're the seller?
Oh, I'm popping champagne. I just got paid for 50 years of work in a single afternoon.
So in a rational market, that transaction just shouldn't happen. The gap between the buyer's need for safety and the seller's greed is just, it's too wide.
The rope snaps.
The rope snaps.
But transactions do happen. Businesses get bought and sold every day. So there has to be a rational zone where people agree.
And this is where the notes draw a huge red line between two different worlds.
Which are?
The private market and the public market.
Okay, let's start with the private market. This is Main Street. This is me buying a local chain of, hardware stores. What's the rational multiple there?
In the private world, the rule of thumb is remarkably consistent. Deals usually happen at a multiple of 4 to 6.
4 to 6, that's it.
That's pretty much the standard, yeah.
So if I buy a private business, I'm saying I'm willing to wait 4 to 6 years to get my money back.
And that makes sense, doesn't it?
Yeah, actually it does.
If you're going to buy a business, take on the stress of payroll, deal with supply chains, you want to know that by year 5, you're in the black.
Anything longer than that feels way too risky for a private individual.
Way too risky. And plus, there's the issue of being stuck with it.
You mean liquidity?
Right, liquidity. You can't just press a button on your phone and sell a plumbing supply company on a Tuesday afternoon.
It takes months to sell something like that.
At least. So you demand a lower price, a better deal to compensate for that stuckness.
Okay, so back to our company. In the private market, our $100 million company is worth about, let's use the high end, 6. So $600 million.
A 6x multiple, a rational, grounded valuation.
Okay, now we enter the twilight zone. We take this exact same company, same profits, same building, same employees, and we list it on the stock exchange.
We make it public.
Does the price stay at $600 million?
Absolutely not. Welcome to what the source calls the public market paradox. The moment that company goes public, the multiple expands. It doesn't trade at 6x, it trades at 15x, 20x, 25x, maybe even 30x.
Wait, hold on. Let's do the math on 30x. That would value the company at $3 billion.
Correct. $3 billion.
So yesterday, as a private company, it was worth $600 million. Today, because it has a ticker symbol, it's worth $3 billion.
That is the premium we see every single day.
But why? I mean, I get that it's easier to sell the stock, so maybe you pay a little more for that convenience, but 5 times more.
It's a huge leap.
Why is a public investor willing to wait 30 years for their return when a private investor demands it in 6?
That is the multi-trillion-dollar question. Part of it is liquidity. Like you said, you can exit instantly so you feel safer. But a huge part of it is one word: growth.
Growth.
When you buy a private hardware store, you expect it to just keep doing what it's doing. Stable. But when you buy a stock at 30x earnings, you aren't really planning to wait 30 years.
You're betting that the earnings will explode.
That's the bet.
So I'm betting that the $100 million profit will become $200 million, then $400 million, and that cuts my wait time down.
Exactly. If the earnings double, your waiting time gets cut in half. That 30-year wait is only true if the company never, ever grows.
But that's a massive gamble, isn't it? The source material seems pretty skeptical of this. It says while growth can happen, the math of the multiple is the only thing that is certain today.
Right. The PE ratio is the cold, hard reality of the current financials. The growth? Well, the growth is just a story we tell ourselves to justify the price.
And the source warns, when you pay 30x, you are pricing in perfection.
You're assuming the growth has to happen. If the company just stays a good company and makes stable profits, you, the investor, are kind of screwed.
You're just stuck waiting for decades.
And it actually gets worse. The notes bring up the fine print that investors usually ignore.
Oh boy.
We've been saying you get your money back in 30 years, but that assumes 2 very, very unlikely things.
Let me guess. It assumes the company gives me all the profit.
Correct. It assumes a 100% dividend payout ratio, which almost no public company does.
Right. They keep the cash to, buy other companies or build fancy headquarters.
Exactly. And the second assumption?
Taxes.
Taxes.
Oh, right. Uncle Sam.
The multiple is calculated on corporate earnings. But if that money actually flows to you as a dividend or capital gain, it gets taxed.
So if I buy a stock with a PE of 30, and the company keeps half the money for itself, and I lose 20% of what I do, get to taxes.
Your 30-year wait could easily turn into a 50 or 60-year wait in reality.
Wow. It really exposes how optimistic the public markets are. We're routinely paying prices that imply we're willing to wait 2 or 3 generations for a return.
It creates this fascinating disconnect. In the private world, cash is king. In the public world, the story is king.
That's a great way to put it.
You have people buying stocks at 50x or 60x earnings who would never, in a million years, buy a laundromat down the street for 60x its earnings.
That's such a great point. If your neighbor tried to sell you his coffee shop and said, it makes $50,000 a year, so I want $3 million for it.
You'd laugh in his face.
You'd call the police. You'd think it was a scam.
But in the stock market, we call that a high-growth tech play.
So why do we do it? Is it just the greater fool theory? Am I just hoping to sell it to someone else for 35x next week?
For many people, yes, I think that's true. They aren't buying a share of a business, they're buying a lottery ticket they hope goes up.
But the deep dive logic here is about grounding us.
Exactly. It's reminding us that eventually a stock is a share of a business. And eventually, the price has to make sense relative to the cash it produces.
The rope in that tug of war can only stretch so far.
Exactly. If the buyer stretches too far, if they pay 80x or 90x, eventually the gravity of the math kicks in.
Which brings us to the present day. We're looking at a market right now that is just full of these high multiples.
Oh, yeah.
The source material specifically points to the giants: Apple, Google, NVIDIA.
These are the heavyweights. And because they are great companies, dominant, profitable, growing investors have given them these massive premiums.
So we aren't going to give you the current share prices because, frankly, by the time you hear this, they will have changed.
Instantly.
But the mission today is to look at them differently.
Don't just look at the logo. Don't just look at the new product launch. Look at the multiple.
When you see that PE number, whether it's 25, 35, or in some cases much, much higher, I want you to do the mental translation we practiced today.
Turn that number into years. If you see a PE of 40, you just say to yourself, the market is asking me to wait 40 years for this money.
And then you have to ask the hard question, is that reasonable?
Right. Ask yourself, is the growth going to be so explosive that my 40 years shrinks down to 10? Maybe it is.
Sure.
I mean, NVIDIA is a great example of a company where the earnings did explode, and it totally justified a high price in the past.
But that's the trap, isn't it? Past performance
doesn't guarantee future results. Buying after the explosion, paying a 60x multiple on the new high earnings, that requires a second explosion.
A third explosion.
A fourth.
That's the risk.
Okay.
You are betting on lightning striking twice in the same spot.
It seems like the core lesson here is just about knowing which side of the table you're sitting on. Are you the rational buyer, demanding a return in a reasonable time frame? Or have you become the optimistic speculator, handing the seller 40 years of cash up front because you're afraid of missing out?
It's a sobering thought. We like to think of ourselves as savvy investors, but when you strip away the jargon and look at the years to return, a lot of portfolios look pretty generous to the sellers.
It's always good to know who's winning the tug of war.
So here is your homework. It's pretty simple. Pull up your portfolio, pick your favorite stock, the one you brag about at parties.
And check the PE.
And ask yourself, if this company never grew another dime, how old would I be when I finally broke even?
And be honest with the answer.
If the answer scares you, well, maybe it's time to rethink the price you paid.
Or at least understand the real bet you're making.
Exactly. Understanding is the name of the game. Thanks for taking this deep dive into the math of value with us. It's not as exciting as a rocket emoji, but it might save you a lot of waiting time.
And time is money, after all.
See you on the next one.